to the Insurance and Money Podcast. We're here to educate on the topics of insurance and money. I'm your host, Karla Howard. I want to thank you for tuning in to the show today. Today, we'll continue our discussion on insurance and mortgages, why everyone needs life insurance, and the different types of insurance. On this show, you can expect to learn about the different types of insurance and how they relate and apply to you. Also, we will discuss your money as well, such as checking and savings accounts, credit cards, and mortgages. On our last episode, we discussed final expense insurance and mortgages, the need to understand a mortgage contract, and PMI insurance or private mortgage insurance. Today, we will continue our discussion on mortgages and insurance. We briefly discussed decreasing term insurance or mortgage life insurance last week, and we're going to pick up on that today. People buy the term product to ensure that the mortgage is paid off if the homeowner transitions or dies before the mortgage is paid off. As I said last week, it's not a very expensive product. It's even cheaper than a traditional term life product because the benefit amount decreases as the mortgage is paid down, but the premiums remain the same. That's one of the reasons I don't recommend decreasing term insurance. Benefit goes down and the premium stays the same. Since term insurance is the cheapest form of life insurance, I always recommend getting a face amount which would include all the debt, not just the mortgage. Also, remember that term insurance is temporary insurance, so it's advisable to buy a permanent policy at the same time you buy the term policy. Why? Because after the 20 or 30-year term is over, the policy either ends or it converts to a yearly renewable term policy. And remember, at this time, you are 20 to 30 years older, so the premium will go up every year and could become unaffordable over time. Now, you possibly need a new policy 20 to 30 years later. And at this time, how's your health? Do you have any medical challenges during this time? If so, you could be rated, meaning higher premiums. Let's consider example one. You purchase a decreasing term policy for your $400,000 mortgage at the age of 35. Well, 35 years later, congratulations, the mortgage is now paid off. Since you bought it to cover the mortgage and that policy has ended, it didn't convert. You didn't see the value of purchasing a universal life policy when you got approved for your mortgage because you wanted to keep costs down. However, did you really keep costs down? Now, at the age of 65, you need insurance, and and with the medical heart challenges you had a few years ago, any policy you buy now will be extremely expensive. While I agree, buying a universal life policy at the same time you bought the home might have been an added cost. However, it would have been way cheaper back then than it is now with you being at retirement age and now having heart issues. This is why I always recommend to people to consider buying a permanent policy at the same time that they are buying a large term policy. You just may need the $400 or $500,000 face amount to cover debt should you transition or die early. But having a small 25 to 30-year $1,000 policy when the large term policy ends or converts will be cheaper than waiting to buy that same policy at age 65 years old. It would be more affordable to buy it at 35 years old. Now let's talk about forced place insurance. Most people who own a home have a mortgage. At the closing table, you sign a lot of paperwork. Some of the documents that you sign are the requirement to have homeowners insurance for as long as you owe money to the mortgage company or lender. At no time are you permitted to be without homeowners insurance. In fact, most of the time, homeowners insurance or HOI is escrowed. What that means is the lender sets up an account called an escrow account. An escrow account is a type of savings account where the mortgage company holds funds for your homeowner's insurance and property taxes. Usually there isn't interest earned. However, if your state permits interest earned, the interest would be given back to the homeowner. You pay into this account monthly through your monthly mortgage payment. At no time are you permitted to cancel this coverage. Approximately 30 to 60 days before the expiration of your homeowner's policy, the insurance company sends the renewal notice to the customer and mortgage lender. This gives the customer time to make changes before the lender pays the invoice. It is the responsibility of the customer to inform the lender if they're changing companies, and it's best to go gather new quotes if that's your plan before the lender pays the invoice. It's never a problem if you choose to change your homeowner's insurance company. Just let the lender know. Communication is the key. I have seen people cancel their policies or even have a short lapse. That's not good because the lender will purchase forced place insurance or lender place insurance at your expense. I want to make that clear, at your expense. The coverage premium will increase your mortgage payment. So now what is forced place insurance or lender place insurance? It's insurance that the lender or mortgage company purchases to protect their investment in the property when the customer does not maintain a proper amount of insurance on the property. The coverage is very expensive and it doesn't cover everything a typical homeowner's policy will cover. Basically, it covers the lender's investment. It won't cover your entire value of your home, personal items, furniture, clothing, liability, etc. For example, if your home is worth $650,000 and you've been paying down on a loan and now you owe say 400,000 and you canceled your homeowner's insurance thinking that you will save money, the lender will purchase forced place insurance or lender place insurance for $400,000. So if you had a total loss, meaning your home burned to the ground, your loan is paid off. And unfortunately, you will need to build your home yourself at your expense. Take note, the insurance placed in this example is $400,000, not the value of your home, which in this case is $650,000. What's going to be covered is what you owe the lender. It's designed, again, to protect the interests of the lender. Therefore, as long as you own the mortgage, never cancel your homeowner's policy. Let's look at example number 2. Pam has a mortgage which she always pays on time. At closing, she signed all the required paperwork and didn't understand all the documents. One day, while reviewing her mortgage statement, she notices that the escrow portion of her statement is high. Her homeowner's insurance and taxes went up that year. So, to save money, she makes changes to her policy and even changes insurance companies. No problem to change the insurance company, but she bought less coverage than the lender is requiring. So now the lender starts to send out a forced place coverage letters letting her know that she doesn't have the proper amount of insurance. And they usually send out 3 letters before the first place coverage takes place. So let's say she had $200,000 of coverage, but the lender needs $250,000. They will purchase $50,000 of coverage, which she will be required to pay. Now let's look at example 3. Joe is in escrow. He has decided to skip paying his homeowner's insurance this year. Well, 3 letters from his mortgage company goes out, and unfortunately, he ignores the letters. But when he is charged forced placed insurance, his monthly payment, of course, goes up. The escrow portion of that mortgage payment goes up. He complains to the company and decides to just send in his regular payment minus the forced place additional coverage amount. That makes his mortgage past due. And for the first time, he is starting to receive collection calls. The only way to get the forced place coverage removed is he would have to purchase new insurance. And since he does have a 30-day lapse of coverage, he will need to pay the forced place coverage for that 30-day lapse period. The premiums for which he can show he has coverage will be canceled. It's a good thing he got it cleared up before his mortgage payment, for his mortgage payment, and that because he wouldn't want to go 30 days late, because if that happened, he would be reported to his credit bureau agency as having a 30-day late, and that would mean his credit score would drop 50 points. As you can see, we can never be without homeowners insurance for any period of time that you have a mortgage balance. Whether you have a mortgage or not, however, you need homeowners insurance. And if you have a mortgage, it is a requirement. Let's look at example 4. I was talking to a friend who was very happy he finally paid off his mortgage. Well, I rejoiced with him as he celebrated finally getting out of debt. He said now he can cancel his homeowner's insurance. I said, wait, you still need homeowners insurance. I get that no one can require you to have it and you can't be charged without your consent to have it. But he said, I own my home now. I know, but you still need insurance. What if you had a total loss, such as a fire? Or what if you had a liability issue, such as it snowed heavy and you didn't shovel in time and someone fell and hurt themselves? Would you be covered? I asked him if he had a huge amount in savings that he could use to rebuild his home if he had a total loss, and his answer was no. So I explained that's what homeowners insurance would do for you. If you have the proper coverage, the policy replaces everything that was lost. In the next episode, we will continue our discussion on homeowners insurance. Now, I've been getting a lot of questions concerning universal life insurance. We'll go into it in greater detail. Thank you for tuning in to the show today. Please tune in every Wednesday at 7 o'clock p.m. and we will continue our discussion on insurance. I have more examples and tips to share. This is Karla signing out until next week.